So if you look at how we're doing today, right, so we try to figure out where are we in this process? Are we going to come out of this? How are we going to do? If you look at what's happened through the first 3 quarters of this year, we've had about $11.5 billion of sales, on pace for 15.3. That'll be about 25% below where we were last year and 73% below the peak. Now, dollar volume is something everybody tends to talk about. It's more relatable than number of transactions, but number of transactions really is much more indicative of the health of the market and activity in the market, because very large transactions can skew those dollar figures. We look at number of transactions. We've had 179 deals over 10 million in Manhattan so far this year. So that's on pace to be up about 6%, still about 50% below where we were at the peak of the market. But there's one nugget that came out of the third quarter stats that I found very, very interesting. When we look at how markets react and how markets change, there is always a period when the market is transitioning and there's something that exerts downward pressure on value. That first year always has the same dynamics. And the dynamic is that value appears to be holding okay, but volume drops like a stone. And why is that? That's because the folks who have their properties on the market and are able to get their price transact. And the people who don't get their price don't transact. So what happens? You have a divergence. And Steve, I know this isn't in the appraisal handbook, but I'll tell you, I believe that in that particular year, there is a difference between comparable sale value and real value. Real value is lower than what the comparables project about the market. And the appraisal handbook will tell you that's not right. That doesn't exist. Knakal, you don't know what you're talking about. I'm telling you it does exist. And there's a certain percentage of the market that's in tune with what real value is, certain percentage of the market that's not in tune with real value. Transactions still happen at the non-real value, creating comp value, but real value is lower. Most people bid at that real value. Sellers don't capitulate. And you have this dynamic where value seems to be sticky, transaction volume drops off. That is the quintessential year in which you have this transition. So the time that it takes historically for sellers to get in tune with what the new reality is typically is about 12 to 18 months, right? And then you reach the point where, okay, this is the new reality. I want to sell. I need to sell. I have a strategic reason for selling. I'm going to transact. It's the market. It's not going to get better anytime soon. That's the point of capitulation, right? And you need the point of capitulation for things to start moving again. And the third quarter activity potentially provided that insight that perhaps we've reached capitulation. And I always caveat talking about quarterly data by saying one quarter doesn't make a trend. It's got to be 2 or 3 quarters. But if you look at the number of properties sold in the first quarter, we had 42 over 10 million. Second quarter, 43. Third quarter, 84, more than doubled. Is that the sign that we're entering capitulation phase and we're going to start to get a lot of this stuff working through the market? I don't know if that's the fact or not, but we're waiting to see what the fourth quarter is going to bring. I can tell you the vibe, the feel is that fourth quarter activity is not going to be as robust as the third quarter. We talk about this all the time. When we're doing BOVs today is so difficult. We sit there, we noodle things around, talk about what's happening, look at activity on deals. And in any market that's changing like this, we're so in tune with looking at what bidding activity is and what contract activity is to get a sense of the market. Comp sales, forget about comp sales. Something closes today, that's indicative of the market 6 months ago, right? So we're looking at what is transacting, what people are bidding, what contracts we're signing or negotiating, but it's really, really challenging. So, but we're hoping that third quarter activity may be a glimmer of hope that we're reaching into that capitulation stage. So If we look at today's correction and compare it to the past, there are two very, very distinct differences between the way the market's performing today and what's happened in past corrections. And I'll tell you, the last three, I mentioned them: S&L crisis, early 90s, early 2000s, and then the GFC. And go back to the S&L crisis, lender behavior and product sector performance, those are the two biggest differences that I see. And let's talk about lender behavior first. Back in the S&L crisis, lenders went through that 2 or 3 year foreclosure process, took title to the property, had an REO department, hired brokers exclusively to sell properties. It was a big boom for Bob Knakal back 92, 93, 94. I mean, that was more than half of our business was selling REO properties for banks. It was great, great business, and the process worked, but it took a really long time. So get to the recession in the early 2000s, and then again in the GFC, lenders didn't want to go through that 2 or 3 year foreclosure process. So what did? They hired brokers to sell notes. Went much quicker, didn't have to go through foreclosure. It was great for the brokers, great for the banks, worked well. This time around, the banks are not engaging as openly with the brokerage community. In fact, we had a few notes that we were selling that when SVB went down and Signature went down, those were immediately pulled from the market. And I think that a big catalyst for that was that the lenders didn't want the general public to be aware of what was happening within their portfolios. So what we've seen is there's been a lot of paper trading from banks, but banks are basically going to their customers and saying, hey, we got this loan over here. You want to buy it at a discount, we'll make a deal with you. But they haven't been openly putting things on the market. So the way lenders have been approaching this period of time is very, very different from what's happened in past corrections. Now let's look at product sector performance. That's another very, very distinct difference between today's correction and corrections of the past. In the past, every single product type was heading downward. It was just a question of varying degrees. Today, I argue that you have to look at the market product type by product type, and they're all moving in kind of different directions. I argue that today, if there's a bright spot in the market, it probably is the retail sector. And why? Because retail has been getting battered for 5 or 6 years now. So the general perception is that retail rents have stopped going down, leasing activity is picking up, and investor demand has started to come back. About 3 months ago, I got the first call from an investor saying, hey, Bob, what retail properties do you have for sale? I said, what? What, you want to know what retail we have? It was the first call in so many years, people looking for retail, but now we're getting more and more of those calls. So I think retail is a sector that could be on the upswing. Multifamily sector is one that is really, really interesting. Clearly, the face and nature of multifamily investing in New York City has completely changed since 2018. And I will tell you that in 2017, we had hundreds of clients that for decades would only buy New York City multifamily properties. We have something for sale in Jersey. They're like, Jersey, forget about it. No, I'm not, only New York City. I will tell you that 85 to 90% of those high net worth individuals and families will not buy an apartment building in New York today. They're buying all over the country, and went through a period of about a year and a half where I kept getting these calls. Hey, Bob, I'm buying a property in Tallahassee. The brokers don't know me. Could you call them, tell them who I am? And so 10 to 15% of the O-line investors have stayed in New York, doubling down, tripling down on New York. But the rest of them are all buying around the country. And I think it's so interesting to see how the nature of the market has changed and how highly correlated market performance is to public policy, much more so than the fundamentals of the market. If you just looked at real estate fundamentals, you say, wow, this market's got to be doing great. But it's public policy that's changing everything, because our politicians don't believe in supply and demand. They don't believe that economics 101 is a real thing. And so they are doing things. Every politician says, we want New York City to be more affordable for everybody. But yet, every single piece of legislation that's been implemented or ignored since 2018 has done nothing but constricted supply and exerted upward pressure on rents, making it less affordable for everybody. So, if you look at the multifamily sector, for my entire career, multifamily cap rates in New York City were about 150, 200 basis points lower than around the country. And today, cap rates in New York are higher than they are around the rest of the country. And that started in 2020. That's because the New York capital, I believe the New York capital all left New York, went to start buying in other places. And you look at an investor in Nashville who was used to buying at a 7 cap or an 8 cap, all of a sudden could sell their properties at a 4 cap. They sold everything and they said, hey, look, I can get a 5 cap, a 6 cap in New York. I'm going to New York. So we have a lot of new folks that are buying in New York today that I don't think really understand rent regulation as well as they should. But the whole dynamic within the multifamily market has changed, and it's shocking the robust demand there is for multifamily in the face of these political headwinds and the specter of potentially good cause eviction and what other changes are potentially going to happen within that space. But that sector still has relatively strong demand.